What should you invest in? On the screen here, you can see the three main ways people typically invest their money. You have mutual funds, individual stocks, and index funds. There are, of course, many other ways of investing. You have bonds, you have different types of funds, ETFs, which are related to index funds, really. There's all manner of different ways of investing. There's Bitcoin, although I'd say avoid that, and that kind of falls under the individual stocks category. But really, most people's investments seem to fall under these three categories. So, which one is best for you? Well, it all depends on what kind of an investor you are and where you are in your investment journey. If you are just starting out, like I am, I would say a mutual fund is probably the best way to go. But once again, it depends on how much money you're throwing into these accounts. If you are starting out with a relatively small amount in the investment world, which I was, £5,000, then a mutual fund is probably a good idea. The way a mutual fund works is you say to a bank or a corporation somewhere, please will you manage my portfolio for me, or this portion of my portfolio that I'm going to allocate to this mutual fund. And they'll say, yep, sure, we'll do that for you, but there will be a fee involved in holding this mutual fund with us. Now, if you are just starting out with investing and you're just starting out with your first £5,000 or £10,000, a mutual fund might be a good idea, because what it will offer to you first is instant diversification. So whenever the market starts to get volatile, which it's possible it might start to happen pretty rapidly in the 2020s, the market has exploded in terms of how many people are joining the market recently. Zoomers are all jumping on the market. They're all getting excited for it. These are all signs of a possible bubble coming up, like the dot-com crash that we had and the 2008 financial crash. Markets go through bull and bear markets fairly regularly. And mutual funds usually are a good way of securing yourself against that, depending on what the mutual fund has in its holdings. What percentage of stocks to bonds is it doing? What kind of investments is it doing? Obviously, research the mutual fund that you're looking into before you go ahead and buy your mutual fund. However, if you are looking to invest a massive chunk of money into one investment, I would say a mutual fund is probably a bad idea for something like that. The reason is those fees that the mutual fund charges. Because mutual funds are run by bankers and finance people who manage your investments on your behalf within that fund, they ask for a fee. And if it's a fee, if it's usually done on a percentage. So for my mutual fund, for example, I'm holding the Barclays Ready-Made Investment Global Markets 3 fund, which is their balanced mutual fund. They are charging, I believe, 0.45% of my expected returns to go to the fees for the managers. And also then they are charging an extra 0.2-ish% for holding it in the investment ISA to begin with. However, you can't really avoid that 0.1, 0.2%. All brokerages, I think, will offer something along those lines in terms of fees for holding it in their accounts. But in general, that 0.45% is pretty decent if you are holding a relatively small investment amount like 5,000. If you were chucking 500,000 into a mutual fund, that's where things could start to get fairly nasty, because all of a sudden it's no longer 0.5% of £5,000, it's now 0.5% of £500,000. And so do you see where this is going? Because it runs on a percentage, mutual funds are best for beginners who are starting out with little capital. And quite frankly, I think most people who are watching this are going to be beginners who haven't got much money to invest in the market. So if you've got £10,000 lying around and you've never ever made an investment before, this is your first journey into the investment market, I would say look at these mutual funds as your first investment. And of course, look at my How to Build Your Portfolio video for information on how to analyze the risk of these different investments and assign them all a risk score. So that's mutual funds pretty much covered. Over to the right hand side here, we have index funds. Now, index funds are fairly similar to mutual funds. However, the big difference is that there isn't a money manager running it. It's passively managed, which means it's basically just tracking some kind of market. So, for example, you can get an index fund for the S&P 500. And that index fund will track the S&P 500 pretty much one-to-one. If the S&P 500 goes up, your index fund will go up. If the S&P 500 goes down, your index fund will go down. And already I imagine you can start to see the pros and cons of this. The pro of this is that, like we said before, you don't have a money manager in an index fund. So there are practically no fees whatsoever. You will probably get a tiny fee just for maintenance of the fund or something, I guess, but there won't be that 0.45% fee like I'm paying with my mutual fund at the moment. So index funds are pretty good for chucking bigger amounts of money into. However, the con of an index fund is it is a little bit more volatile than a mutual fund. Not by much. Mutual funds do still go up and down because money managers, they will get things wrong sometimes. They're not going to be perfect. However, an index fund is a little bit more volatile than a mutual fund. And so if the market is going to go through a bubble, if it's going to go through some kind of crash, you will probably see bigger losses on your index fund than you will on your mutual fund. Although, of course, it depends on what kind of mutual fund you had. So that's mutual funds and index funds. And both of those options, I think, is really where most people should be sitting at in terms of starting out in investing. The one in the middle here is individual stocks and shares. And this is where it can get pretty nasty. This is where you see people making huge losses on apps like Robinhood and in the Bitcoin market. The problem with owning individual stocks should be fairly straightforward. It's not diversified unless you're buying, 1% of your portfolio into a bunch of different stocks and you're doing your portfolio as a DIY, which is probably going to rack up more transaction fees, let's be honest, than if you just put it into a fund. If you are doing it that way, then yes, you might avoid a lot of the pitfalls of owning individual stocks. But most people who are going to go into the individual stocks world, they're going to put like 30 or 40% of their stock portfolio into one company, like Coca-Cola or Apple or Microsoft. And I shouldn't have to tell you how vulnerable that investment would then be to market crashes and the ups and downs of that individual investment that you've made. If we take the IT sector as an example, the IT sector right now is very much booming. It's in a boom, but anyone who's been in this game for a while will probably know that that's the first sign of a bubble approaching. Many investors right now are worried that an AI bubble is happening with stocks like Microsoft and Apple and things like that, because they're all investing in AI this year. But people are wondering if it's going to be the next dot-com crash, because we saw this in the late 90s where people were just buying these IT stocks left, right, and centre, thinking they're all going to go to the moon because, it was the late 90s, early 2000s, and people were optimistic for the future. However, what happened in the 2000s was the dot-com crash, and people suddenly got a reality check and realised that all of these big IT stocks that they'd invested in, they'd massively overvalued them. And I think something is possibly happening like that with AI as well. Now, if you've got stocks in a mutual fund and an index fund, you're probably going to see a dip on that as well if the AI bubble happens to be real and that bubble pops. However, with a mutual fund especially, you're probably going to be shielded from the worst of it. With an index fund, it depends on what kind of market the index fund is tracking. And with individual stocks, if you've put 100% of your portfolio into Microsoft stock, all I would say is you should probably go looking for a skip right now because you're going to be living in it very soon.